going to have a panel now on ship finance. Traditionally, we have commercial bankers or alternative financiers on this panel, but we take a different approach this time. We are going to have the CFOs tell us about their financial strategy, their capital allocation, and so on. And Kurt here is going to be our moderator. It's a novel approach for this panel, and I'm delighted to have it.
Kurt Plankl, Holland and Knight, as Nicholas said, delighted to be here. Thank you. Moderating the finance panel. It's comprised of real leaders in our industry, an industry that had the reputation of changing slowly, but these days it's changing each year, each month, and day by day it seems. And these gentlemen are going to help us understand how to navigate those challenges. To my left is Dr. Anastasios Aslidis, the Chief Financial Officer and Treasurer of Euroseas and EuroDry, as well as the Chief Strategy Officer of Euroholdings. Those companies are in the container ship and dry bulk segments. To his left is Henry Williams, the Chief Financial Officer and Treasurer of Pyxis Tankers. Immediately to Henry's left is Thanasis Antonakis, the Deputy Chief Financial Officer and Chief Compliance Officer of Safe Bulkers. And last but not least, Stavros Gyftakis, Chief Financial Officer of Seanergy, Maritime Holdings, and the Chief Financial Officer and Director of United Maritime Corporation. So before we start hearing how to navigate these challenges, our panel is Capital Choices at Sea, Optimizing Ship Finance Strategies. And I thought it'd better to start with a more foundational question for our CFOs about leverage. People often think that choosing the right leverage is the key to balancing strong investment returns with appropriate risk. And maybe I'll direct this first question to you, Stavros. What is the optimal leverage for Seanergy at the moment, and do you see any deleveraging trends going forward?
Thank you, Kurt. Good afternoon to everyone. We got the difficult slot right after the exciting CEOs. We get to bore you to death with leverage and bank financing and what have you. So, when we're talking leverage and loan-to-values, I think you have to put in context also a couple of other factors. First of all, the specific company and the sector under which it operates, the outlook of the sector, where actually the sector in the shipping cycle is, and the business model of the company. As Stamatis discussed previously, Seanergy is a company which is focusing purely on Cape-size vessels. What we do, and we think we do it well, we invest in mid-aged, sort of 10 to 15-year-old ships. We repair and maintain the ships to make them and also install energy-saving devices, apply silicone paints and what have you, to make the ships more competitive, actually being able to directly compete with the younger ships in the sector. And basically, we distribute 50% of our free cash flow out in dividends, and we like to see the company growing next to rewarding its shareholders. At the same time, our sector, again, as it was very clearly discussed in the previous panel, the outlook of the sector is steadily positive, and we see also some upside going forward. So basically, in this environment, I do think that operating with leverage between 50 and 60% can get you in bad places, so to say. A Cape-size and unlevered zero debt Cape-size of around 10 to 15 years old costs today at around 30 million. So basically, assuming zero leverage or 50% leverage at a rate environment of around 20,000, that results in a cash return on equity of around, 11 to 15%. But if you go higher in rates, so if you go up to 25, 30, 40,000, then the return on equity increases exponentially in a levered investment compared to an unlevered investment. So taking into consideration the outlook of the sector, the business model of our company, we like to operate under moderate levels of leverage, so around 50%. Now, if you ask me if the market goes down, how will that 50% look? It will look around 60, 65%, and we still feel comfortable with those levels.
Thank you. Does Thanasis or Henry, a different thesis on that or a different approach?
Yeah, from the standpoint of Pyxis, right now, net debt to total capital runs about 20%. So we, from our standpoint, are under-levered. If we look at a new project right now, we're primarily focused utilizing cash, which is roughly about, available cash, about 42 mil. And we also have a hunting license from one of our banks for up to 45 mil. So we are happy, and our banks are on board for us to, I'd say on an average, have a borrowing that's roughly 55% of the purchase price of a vessel. And so for us, it really comes down to the quality of the vessel. You know, for us, it's while day one leverage is important, the question is what's the cash break even? And we utilize various time charters, staggered time charters, and basically they go anything on the dry bulk side, because we have 3 dry bulk units and we have 3 MRs. We basically utilize TCs that can be anywhere from 90 days to roughly 1 year. And that's how we approach the business. So we try to mitigate risk by having that TC cover. Borrowings today, you know, very attractive from the standpoint of our banks. It's, you know, SOFR plus 190. So we're well under 6%, very, very attractive 5-year maturity. So we are comfortable being in a more leveraged situation. We are not that right now. We look to expand our fleet, and so there will be probably a time where we will be more levered.
Dr. Aslidis, you know, having container vessels and dry bulk, do you take different positions with leverage across the different segments, or do you think about it the same?
Let me start first by saying the leverage is good. We like leverage because it enhances project returns. The right amount of leverage. And your distinction and comparison between the two sectors is a very timely one, because on the container ship side, I'm looking at our companies, Euroseas, is relatively cash rich. I can modestly say it's relatively cash rich given the contracts and the visibility we have. So one could argue that leverage is not even necessary. We could sort of repay the majority of our loans and operate on the basis of more equity financing. But we want to maintain a certain level of leverage, modest, 40 to 50%, depending on the situation, to enhance shareholder returns and increase our capacity to utilize capital in other ways, to pay dividends, to do repurchases, to do projects. On the other hand, on the dry bulk company that we have, EuroDry, the sector is doing well the last couple of months, but it has come from a period that it was challenged. The 9 months before the last 3 months were pretty difficult, and generally cash flow was very tight. So there we are careful to use leverage as a way to maintain positive cash balances and to be able to carry on our operations and investments as opportunities appear. So depending on the cycle, we tailor our leverage and the level of debt we draw.
Thank you. Maybe a slightly different question for you, Henry. You know, one way that you've been accessing financing was issuing warrants. I saw it, you know, a lot going on in the news these days, but I saw yesterday your public warrants expired. I'm curious about that. Is that a good thing for Pyxis tankers?
Yeah, it is. It basically, obviously, saves potential dilution and basically enhances financial flexibility longer term. Maybe what I should do is give you a little context behind the issuance. These were 5-year warrants that expired yesterday, and we did a financing back in right after COVID. Very difficult time back in the summer of 2020, clearly from the standpoint of what was happening worldwide, as well as specifically in the product tanker business. And so we decided to undertake a restructuring the business financially and to some extent operationally. It was going to take a period of time, and one of the key elements to that was issuing a very attractive convertible preferred stock. And we were able to do that, but we had to put some warrants on it. Fortunately, the strike prices for the warrants and the convert itself was a premium to the current trading price at that point in time and basically reflected NAV. And so we were very fortunate in being able to do that. That gave us the opportunity with that equity on the balance sheet to move forward with a number of initiatives. Net result is, operationally things improved, cash flows picked up dramatically. We did other various financing. We sold some older tonnage. Net based upon, two research analysts, recent research reports, our NAV is roughly $11 a share. So we've made a lot of progress over the last period of years. We also took that opportunity to further diversify our operations. We decided to move into the dry bulk business, and we did that effectively about 2 years ago. So for us, it was a strategy, a means to an end by putting warrants on an instrument that was very attractive from the standpoint of a convert, and it propelled us to do other things. Clearly today, with the redemption of the expiration of the warrants, we sit with a very simple equity structure. It's basically common stock. There's no other instrument. It's one share, one vote. Insiders control roughly 59% of the pie. There's no other crazy instruments that have super voting rights or any dilution protection or anything like that. It's simple, stupid common stock, and we think that's great. That also gives us the opportunity with that type of simple common stock structure to make it appealing. So if there was a ship for shares type of transaction, albeit we're way under valued vis-a-vis NAV, those shares are pretty straightforward. In addition, clearly for any strategic M&A opportunity, again, it's straightforward. You don't have to worry about some potential dilutive type instrument, et cetera, et cetera. So net, the transaction was very beneficial. When we did the financing back 5 years ago, it served its purpose. We were able to basically have those warrants traded in the public arena. The investors made a lot of good money over a period of time, and it was successful for the company, and we're well positioned today with good operations, good cash, and opportunities for growth.
Thanasis, anything you want to add or on leverage or anything related to what we've just heard?
Look, for us, it's been very important to keep leverage at levels that we consider to be comfortable, meaning that the last 4 years, with all the renewal of the fleet, we managed to keep our leverage below 40%, which is a level that we feel it's very safe in case we feel markets going down again or in case of a downturn. But we have accessed the markets in multiple ways, and resiliency is one of the things that Safe Bulkers is known for. Our conservative approach for the leverage is not an exception to that rule. We have been very stable into renewing our existing fleet, either by selling more than 60 vessels the last 4 years and replacing them with a newer tonnage. We bought 9 second hands during that time, and we also took delivery of 12 new builds, phase 3 vessels. And we did all that without compromising our financial discipline. We're very capital disciplined, and we're going to maintain that.
Let's talk about your fleet renewal a little bit, or actually let's talk about your vision really in terms of sustainability goals, Thanasis, and IMO regulations and being competitive. I mean, you're making big capital investments in something that there's not universal agreement on. Is that like a competitive advantage for you, or do you see it's a necessary step?
We initially approached all the changes in the regulatory environment not as a compliance exercise, and that was based on the strategy of the company behind the Hadjiano family that controls almost 50% of the capital, the common shares of the company. Now, historically, that family invested heavily in new builds in Japan. That strategy moved on as the company became public, and we found that avoiding the compliance exercise and being really pragmatic on our approach about investments is what differentiates today Safe Bulkers from our peers. We have placed 18 Phase 3 new builds the last 3.5 years. We've already taken delivery of 12 of those vessels, and we see real results in our bottom line. We're enjoying the premiums on those vessels, and that was half of it. The other part was renewing the fleet and keeping our average age stable at below 10 years old for the last 4 years. Having said all that, the pragmatic approach stands that lowering our emissions means that we have access to better charter markets and charter access. Lowering, on the other hand, emissions means that we have lower taxation. So sustainability might be a nice word. We might have a nice sustainability report, but it actually translates to our bottom line and the resiliency of the company.
Thank you. Stavros, similar viewpoint. I mean, IMO net zero is coming down. It's on the horizon. Thinking about fleet decarbonization. Are there opportunities, or how are you viewing that these days?
Of course there are, but as I've discussed previously, I mean, our model is rather focused on the more vintage, I wouldn't say vintage, but mid-aged kind of cape sizes. And we do invest heavily on the ships. I mean, our competitive edge is rather on the price that we are achieving when buying the ships. But we know beforehand, I mean, when sourcing these opportunities, that we might need to invest a bit more than the typical dry docking in the next instance when the vessels go through their survey cycle. We have implemented a certain model which combines energy-saving devices with proactive hull treatment, application of silicone paints, and we have seen out of the charter rates that we have been able to achieve that the vessels can continue being competitive. So if you combine this with the fact that you have a close to zero order book on the capes and that the average age of the fleet is around 15 years old, I think that our model, it's a very fit model for the specific market and for the specific sector. And we have managed to work together with our charterers in implementing this energy efficiency improvements. They are happy to test the ships after the dry dockings, and then based on the improvement in the performance, improve also the charter rates or the index-linked rates. We have managed to work together with our financiers, either in getting sustainability-linked loans and receiving incentives on the pricing side based on certain emission reduction targets. We're actually now working with a Danish bank which was happy to advance a top-up facility on 3 2010 built capes, because when we took the ships to dry docking and after installing the energy-saving devices, after treating the hull and what have you, we upgraded the environmental rating of the ships from a D to an A+. So basically, this bank is one of the first Poseidon Principle signatories. They are very sensitive on ESG, but they were happy to top up an existing loan, to advance more money on 15-year-old assets. So basically, I think that the strategy works. We get awarded by both our charterers and our financiers, and for the time being, this is the way to go. Of course, we see at the same time values on second-hand ships increasing very aggressively. At this point, buying a 5 or 6 year old Capesize would cost you anything between 6 and 65 million. So basically, new buildings right now are starting to make a bit more sense than a year ago or 2 years ago. So we might be looking to selectively do a couple of investments on the new building front. It's maybe too soon now, but we are more actively looking at the space right now.
And any particular alternative fuel type, or?
No, we are very boring in the choice of fuel. We like traditional, fuels. We don't think that the shipping companies, especially the dry bulk companies, because as Tassos very correctly said before, we have gone through relatively challenging years. The market has performed relatively better after COVID, but nonetheless, you cannot compare dry bulk to the generational wealth that was produced from tankers and containers. So basically, if there are much richer companies, much bigger companies that can do some research on alternative fuels, and basically we think that the solution will present itself with the passage of time. We don't believe that we should be first movers on the alternative fuels. So for the time being, it's traditional fuels for us.
Dr. Aslidis?
Yeah, on this point, if I can follow up, to be able to be a pioneer in selecting, in quotes, the fuel of the future, you need to have your own infrastructure worldwide to be able to support it. Big liner companies like Maersk and the likes of them have the regular sailings because they have a network of schedules in place and have the size and capacity to take a risk, make a move in using ammonia or methanol or what have you. Smaller companies like, I think all of us, even Safe Bulkers and Seanergy, and especially on the dry bulk side, where there is no standard sailings, it's hard to take a bet on the fuel of the future. The same thing, the same philosophy we have incorporated in our choices, investment and new building choices. We are building, because we have embarked Euroseas on we built 9 ships and we are building 4 more. We have selected them to build the best ships with the conventional technology and make some provisions for LNG fuel down the line if that becomes the preferred fuel. So that is as far as how you deal with the net zero targets, etc. In that process, the change cannot happen overnight, so it will take a generation of ships to move all of the fleet into the new standard. So while this new standard is being searched for, we are investing, as I believe Stavros mentioned for their ships, in making existing mid-late ships more efficient, and these savings, to the order of 25% on for some of our container ships, fuel savings of 25%, are gained by all of us, our charterers, the environment, and us through better commercial attractiveness of our vessels.
So how do you all balance shareholder returns with fleet renewal or these big capital investments? Are you trying to return, making these decisions now to invest in your companies or return capital? What's your current philosophy, I guess, Dr. Aslidis?
Yes. If you have earnings, it is right to return some or all of those earnings or a good part of those earnings to your shareholders. Euroseas, which is, as I said earlier, has great contract visibility and earnings visibility, has consequently the ability to set dividend levels that we feel under normal scenarios would be there for the next 2 or 3 or even more years. So we have a program in Euroseas trying to balance what we invest for the future of the company, our new building progress that I mentioned, with our dividend program, what we return to our shareholders. We pay a dividend at today's price around 5% annualized, and also share buybacks. At certain levels of our share price, it makes sense, and we have bought over the last 2 or 3 years a good part of our shares back. And at the same time, keep some firing power available to capitalize on investment opportunities. As we discussed in previous panels, there is a lot of uncertainty around us these days. Opportunities could emerge.
And both within the MR2 space, potentially mid-size dry bulk vessels. We have 2 Chinese-built Kamsarmaxes and a Japanese-built Ultra. So if there are good opportunities, we want to take care of those events. But clearly, we will continue to abide by any changes potentially in regulations while we have concerns about the net zero framework, and obviously you've all heard about a number of varying issues and concerns. Net, whatever ultimately happens with that, we will abide by that and all regulations, and look forward to maintaining a productive fleet, clearly for the benefit of the company, our shareholders, and of course our charterers.
Different viewpoint there, or anything you want to add? Or?
I don't know, from our side as Seanergy, I mean, discipline in capital allocation is key, and we have a very specific dividend policy whereby we distribute 50% of free cash flow, and then with the rest, we either reserve some because the Capesize, volatility is inherent in our sector, so we reserve some in order to be able to meet our obligations in quarters that are weaker, or we invest A, in making the ships more efficient, and B, in growing the fleet. But I mean, it's kind of a trial and error situation. I mean, you have to, depending on the shareholder base, some shareholders are happier to see dividends, some shareholders are happier to see the business growing. At the end of the day, we own depreciating assets. You have to look after the longevity of the business as well. But I mean, we like to do a bit of more.
Thank you. Let's talk about lease finance. Some of you use it, some of you don't. It's maybe a little more controversial depending on how you've structured that lease finance. Does anybody have any strong views on using that in the future for maybe fleet renewal or helping with getting some liquidity?
Yeah, I can start in saying that we do use lease finance, and not to a great degree, but I think especially financial institutions in the Far East are entering or want to enter into the shipping markets, and the main way of entering is through lease financing, and we have tried and used Japanese and considered, or haven't used yet, Chinese leases. I think one part of a CFO's job is to increase optionality to finance the growth of the company and the operations of the company, and you have to do that. Lease financing is one of those options, and along with bank debt, should be part of our arsenal of funding possibilities.
Thanasis?
Yeah, for us it goes the same. Back almost 10 years ago, we were one of the first companies that accessed the Far East sale leasing houses, mostly in Japan. We did almost 150 million in JOLCOs and another 150 million in Chinese sale and leaseback agreements. Optionality, as mentioned by Anastasios, is the thing here, the key thing that we managed to cap. We also, as soon as we find good pockets of liquidity, we try to take advantage of them, as we did 3 years ago by touching the bond market in the Athens Stock Exchange. And wherever we can find a good deal that makes sense and fits our conservative and disciplined capital structure and capital discipline, we will take advantage of that.
Stavros, different viewpoint?
Agree. I mean, we try to keep an open mind. We try to have as many options as possible, depending on the project. I mean, we have certain sources of capital that we tap. If we want more flexibility and we don't care that much about the cost, then we would address the project to one of our lessors. I mean, we have like 50% of the fleet is financed through sale and leasebacks, both in Japan and China, and I think it's 25% of the fleet is in China, 25% is in Japan, and the rest is through traditional bank debt. Leasing is becoming very competitive in terms of pricing lately. That has also to do with prepayments that the lessors received because of USTR. So now the pricing is directly comparable with the pricing of European banks. And at the same time, the fact that it provides much more flexibility in terms of higher advances, very limited governance, very limited covenants, maybe even no loan to value for a publicly listed company, because you know that eventually the markets will go down, valuations will decrease, and the last thing you want is to start discussing again covenant breaches and VMC breaches with your lenders. So basically, it's a flexible form of capital. It can find its way in your capital structure, and basically you have to do a bit of everything, because there are certain projects that are more fit to our traditional lenders, the Greek banks or the banks from the Nordics, and there are certain projects that are better fit for leasing. So we do a bit of everything.
Thank you. Henry, I think Pyxis Tankers has a different view.
We have done Japanese leasing from the standpoint of the private side. On the public side, we have chosen not to do that. And we've talked to leasing companies all over the world, going back many years. Obviously, the advance levels have come down from what they were. It used to be 85%. The coupons or effective cost was a lot lower. Things have changed. They've still wanted for us a parent company guarantee, which was not exactly something we wanted to do. We also felt that for some of the leasing companies, we looked at it as, we like a personal relationship, and because obviously shipping is very cyclical. Things can change very quickly on the downside, and we appreciate having a strong relationship with our traditional commercial banks. And while they sit there and say to us, KYC, we say KYL, know your lender. And obviously there have been some leasing companies where the people you thought you knew were no longer there, and we did not want to be in a situation with somebody halfway around the world when things were getting upside down and you didn't know who to talk to, and you just were like lost at sea. So we basically, from the standpoint of a small public company, we do it the traditional way. We're more than happy dealing with our banks. Obviously, the scrutiny that they provide, the amortization that they require, et cetera, covenant patterns, we don't have any issue with that at all.
Talking about tools in the toolbox, have any of you accessed the bond market lately or thinking about it in the future? Maybe Norwegian bonds?
I think that's another option, and we're evaluating that option as well. Also, margins there are quite competitive as well, but again, what we said is leverage is good, optionality is better, and bankability of your group is crucial. So you should be able to always have access to funding options.
Yeah, I might just chime in. Obviously, the bond market, you've seen some very nice issuance recently. Thanasis, 500 mil, 144A here in the States, and the Norwegian market is clearly open. From our standpoint, given the size of the company, we're too small. The cost would be prohibitive, et cetera. So we look at it as, could that be something down the road? That's a possibility. Obviously, bullet maturities, et cetera. But, from our standpoint, again, the banking relationship, commercial banking relationship are great. We're now below 6% while there's amortization on that. It's 5-year maturity. That type of lower cost of capital versus a fixed piece of paper to us in this environment, and obviously with SOFR potentially declining another 25 to 50 bips, that makes it even more compelling from the standpoint of cost of capital.
Thanasis or Stavros, any differing view? Or?
We share the same view here. We feel that Oslo definitely is a choice with tighter spreads, making the pricing competitive versus, SOFR loans. But we feel that it needs to be on a structural level. We ourselves, as I mentioned, we tapped the Greek market. We couldn't walk away from a deal that was below 3% back in 2022 for a 100 million euro bond. And whenever we find a good deal, we will do it, but without compromising, our pricing levels and whatever we have set as a target at any given time. Having said that, we feel that the structure is very important. We feel that bonds clearly make better sense on the holding level of the company, whereas on the asset level, term loans are making more sense.
I think it's the same for us. I mean, we like the Norwegian bonds. We like as a product. It offers flexibility in the sense that you don't have amortization. You pay only your coupon, and then basically you repay as a bullet at maturity. And we like the overall system in Norway. We like that the local banks that are supporting the industry, the analysts are creating awareness around shipping, and the fixed income investors there are very, very educated. We've done earlier this year a roadshow in Norway. We concluded that it's not the right time for us to proceed with this product, and the reason for that is basically that Nordic bonds have become very competitive because the fixed investors are advancing against revenue backlog, especially in tankers and containers. Dry bulk, unfortunately, is not there. We don't have long time charter coverage. The charterers are not offering long-time charters at attractive rates. So basically, we cannot offer, as a sector, we cannot offer the long-term cash flow visibility that fixed income investors are looking. And therefore, we think that the pricing towards dry bulk companies is a bit on the aggressive side right now. We think that the tide will change at some point. We are very bullish, very optimistic about the outlook of the sector. So eventually, we will be able to tap the product at a more favorable pricing.
It's a good segue into the last question, really, just getting your views on looking ahead. And what structural shifts do you foresee in ship finance over the next 3 to 5 years? Or alternatively, do you expect changes in investor expectations? Maybe I'll start with you, Dr. Aslidis.
I don't expect dramatic changes. I think we'll rely, if you asked me this question 5 years ago, probably not dramatically has changed. We'll rely on bank debt, we'll rely on all the sources of funds that we discussed. One thing that I want to mention is that we talked a lot about debt financing, a debt-like finance. There's obviously equity finance, which for most of our companies, because we trade below NAV, it's sort of prohibitive to go to the capital markets. We have employed a method of financing through the public company certain vessels as projects. So EuroDry, our dry bulk company, has bought 2 ships having private partners. Investors bought 39% of each of the two ships, which were part of the public company. So that's another way to finance a bit your growth, and perhaps doing more of that. And certainly people from Northern Europe are more amenable to hear these types of projects. Could be a way to broaden the options that we have to finance our business.
Henry?
Yeah, I don't think there's going to be much changing really in the debt side of the equation. So there's a lot of opportunities there, whether it be the bond market or traditional bank financing SLBs to some level for the right parties. I would say we have deployed joint ventures, albeit through affiliates, and those have worked out very well. We would look to try to pursue other opportunities like that. So you may see some situations in that area. But, you know, again, the difficulty on the equity side is we trade at a huge discount to NAV, and that's a real challenge. Obviously, if there was an opportunity to do another convert on the right terms, that's something we would readily consider, and that's, you know, you find certain players, Golar has historically done that, Frontline has done that very successfully, so we love those types of instruments. And so we'll just have to see. In the meantime, just generate, you know, excess cash flow, you know, continue to manage the balance sheet and look for good growth opportunities.
Thanasis?
We believe that we are going to see increasingly sustainability-linked loans. We ourselves have done more than 150 million the last 2.5 years. We have more than, at any given time, more than 10 vessels under this kind of financings. But what really worries me is the possibility of financing protectionism. We see a trade that is increasingly, you know, towards complexity. We see tariffs, sanctions, carbon taxation coming in. We see over-scrutiny and over-regulation for an industry like ours, which traditionally has been not so complex. We have the size and the scale to access any kind of financing opportunity as long as the complexity of the product isn't preventing us, both us as a company and our shareholders, you know, to do the right thing. And the right thing is to keep the capital discipline there, to have our order book delivered in time, and to produce revenues and the bottom line at the end of the day to give back return on investment.
Thank you. And Stavros, to clean it up?
Yeah, I think I agree pretty much with everything that has been said, and I agree with Thanasis that I don't see much changing. Shipping finance will continue to be predominantly a relationship business. I mean, it has been tested as a transactional or a corporate kind of lending. It hasn't fared that well there. I think that also the lessors in Asia, both in China and in Japan, I mean, they're basing the model more on the borrower rather than on the asset and the transaction nowadays. And I'm happy to see that because they get to understand, I mean, they invest more time in understanding the business that they're engaging with and the people that are on the other side. And we like this approach a lot. So for borrowers, I think, I mean, following a diversified approach whereby you have, as Thanasis said, all your options available and you tap each one depending on the underlying project, I think that's the way to go going forward. But I'm very glad to see that we have so many options coming back on the ship financing front. I mean, if we were, Nicholas stopped CFO Panelists for 5 or 6 years because we had nothing to say. I mean, it was basically alternative lenders, credit funds, private credit, and that's all there was to it. I'm very happy to see all these options being available again to us. And basically, we are also following a more disciplined approach. We're not abusing anything, even though it's cheaper, even though it's abundant, even though, I mean, you can do it in higher loan-to-values. Nobody's there to abuse financing these days. So I expect all these alternatives to be there for us going forward.
Thank you. And I think we're out of time, so thank you to my panelists for really making a dynamic contribution.